Welcome to the Business Credit and Financing Show. Each week, we talk about the growth strategies that matter most to entrepreneurs. Listen in as we discuss the secrets to getting credit and money to start and grow your business. And enjoy as we talk with seasoned business owners, coaches, and industry leaders on a variety of topics from advertising and marketing to the nuts and bolts of running a highly successful business. And now, to introduce the host of our show, financial expert and award-winning author, Ty Crandall.
Buddy, welcome to the show today. Today we're going to be diving in and talking about 5 critical factors that determine your business credit worthiness. This is going to be essential when it comes to getting business credit, and it's also really, really important when it comes to getting loans as well. So business credit, when we talk about this, remember, we're talking about credit that's under your business's name, not consumer credit. So today we're talking about your business credit worthiness, things you should know about business credit and how your business credit is perceived by lenders, credit issuers, suppliers that want to give you money. This is not to be mixed up with consumer credit. So when we talk about business credit, the scores reflect how well the business pays its bills, not the actual business owner, which is the main difference between consumer and commercial credit. With commercial credit or business credit, you're talking about a business's ability to repay its debts. And with consumer credit, you're talking about the consumer's ability to pay your debts. What's nice about separating these two, of course, is that when you establish business credit and you become business credit worthy per se, then what happens is lenders, credit issuers, suppliers stop needing to rely on your personal credit for approval. So again, business credit can be very different than consumer credit. The scores alone are considerably different than what you're going to find in the business credit world. So another important thing to know is that the business credit reporting agencies are not subject to the Fair Credit Reporting Act. So a lot of people have questions about disputing negative items on business credit reports or the credit bureau's responsibilities, et cetera, et cetera. You have to keep in mind that a lot of rules of the Fair Credit Reporting Act don't apply in the business credit world. None of them do, because that law only governs consumer credit reporting, not commercial credit reporting. This is why anybody can see your business credit report without your permission. This is why there is no set protocol with how disputes must be handled and so many other things that we're going to be talking about today. So as a result, as I mentioned, anybody can pull your business credit report. This means vendors, competitors, prospects, clients, suppliers, lenders, credit issuers, anybody who wants to can easily pull your business credit report. It's so easy to do, as a matter of fact, that when you go to a place like Dun & Bradstreet, the first option you see is they ask you, do you want to pull a business credit report for your business or somebody else's business? So when you go to get commercial credit reports, they even will give you, with some monitoring services, access to other credit reports from other companies that you can look up. This is just so easy and simple to get. I've also found it's fairly simple to get the ability to pull business credit reports and look at them directly from the reporting agencies. To pay $7, $8, $9, $10 a report to pull reports on anybody that you want to pull reports, unlike the consumer world where you'd have to be a lender of some sort to be able to do so. So when we talk about creditworthiness, we're talking about basically a lender calculation, how lenders determine the possibility that you as a borrower might default on debt obligations, or on the opposite end, may actually pay the obligations as agreed, which is obviously what they're looking for. So according to Investopedia, it's evaluation performed by lenders that determines the possibility a borrower may default on his debt obligations. It considers factors such as repayment history and credit score. Lending institutions also consider the amount of available assets and the amount of liabilities to determine the probability of a customer's default. So when we talk about business credit worthiness, we're talking about how basically your business looks to lender suppliers, those people that issue money, to determine whether or not you may or may not default. If they obviously determine you may default, well, then that's what prevents you from getting the loans and credit that you want to access. But if the opposite is true, if they look at you as a low risk of default, then it becomes much easier to be able to obtain business credit and loans, credit lines as well. So quite simply, the more creditworthy your business is, the more likely you're going to get favorable terms. Actually, I look up this 3 different ways. Your creditworthiness will determine, 1, if you get a loan or credit line, if you get approved or denied. 2, the rates and terms you'll pay on the financing you do secure, and 3, the amount of money you do secure. Your creditworthiness ties into all of those. So, for example, even if you easily qualify for business loans, your creditworthiness is still going to determine how much money you'll get and the rates and terms you'll pay. Even if you can't qualify for business loans, well, then your credit worthiness will depend on your ability to get $20,000, $30,000, $40,000, $50,000 credit cards from credit issuers using your EIN, even when you can't get qualified for loans. And it can also mean the difference between, again, getting approved or not getting approved. And it also will determine the amount that you're going to pay on those terms. So it really factors into all three. Do you get approved or denied? The terms you're going to pay, and the amount of money you're going to get approved for. So let's talk a little bit more about these factors that affect your actual business credit worthiness. Now, the first we're going to dive into is your business credit score. Now, this is the overall measurement of whether your business should get credit. It really is the overall measurement determining your risk of default. This is a mathematical calculation that does just that. So business credit scores from D&B, Equifax, and Experian are the most commonly reviewed by lenders, and it's also important to note that they all have about 5 scores that you may see on the report. So for example, you may be familiar with your Paydex score from Dun & Bradstreet, but you might not be familiar, for example, with their D&B rating. So again, these scores from these reporting agencies are the most commonly used, and all of them have about 5 scores depending on the purpose to determine if they are scores that a lender or supplier will use. So the scores can vary, and as these credit reporting agencies, calculations can differ between the scores that they're using, and the score ranges will differ too, as we'll talk about. But they could roughly be the same, as they consider the same things, meaning in the end, business credit reporting scores, Equifax, Experian, and D&B, the main scores that they offer, basically are designed to determine your risk of going 90 days late in the next 12 months. That's exactly what they all are calculated to basically show. And on the consumer side, it's very similar. In the consumer credit reporting world, the scores are designed to depict your risk of going 90 days late over the next 24 months versus 12 months in the commercial world. So for new businesses or sole proprietorship, lenders and credit issuers will also look at your personal credit score in some cases. And this is the misconception about business credit. A lot of people think that your consumer credit always has to be looked at, and that's just not the case. The reality is that your consumer credit will be looked at when you don't have enough business credit established. As you establish more business credit, then your personal credit is needed less and less and less. So for example, with business credit cards, it's very easy to establish enough business credit to get approved for almost all different kinds of business credit cards within about 6 months or less without needing personal credit. Whereas to be able to get loans based on business credit, not needing your personal credit, could take many years of you establishing really good and deep reports before you could actually qualify. So again, this is all because your business credit score is understandably low or non-existent. And this is something people aren't used to. In the business world, you will be issued a failing score if you have no credit reporting. If Experian and Equifax know you exist, for example, then what will happen is they will give you a low score just because they know you exist, even if you have no credit reporting. So if a lender or vendor asks for your social security number, it means they're taking your consumer credit into consideration. It's that simple. Look, you can or cannot supply your social. That's your choice. If you apply for a business loan and you're pretty newly established, well, then if you don't supply your social, they're just going to deny you or won't even process your application. But for business credit cards, they're going to look at your business credit quality to determine if you'll get approved or not. And again, if you are newly established, they may want that social, they may want the personal guarantee, but never be deceived. Just because they ask for a social doesn't mean you need to provide it. But if you do provide it, they are on almost all cases going to pull your personal credit report. So again, that would mean that there's an inquiry on your consumer credit report, and that can lower your scores. But look, let's be honest. Consumer credit inquiries are not going to lower your score very much at all. Inquiries themselves don't lower your score even a point. Groupings of inquiries do. So if you try to go get a bunch of credit in a short period of time, that could lower your score. Whether or not you got approved and those accounts show on your credit report or they don't also factors into inquiries. So there's several things that factor into inquiries. But what hurts you more in our world, the business loan world, is that even one inquiry can cost you 10, 20,000 or more in funding, meaning that we've got unsecured lenders that look really, really, really aggressively at inquiries. And if you have 1 versus 2 or 2 versus 6, it will mean the difference between you not getting funding, getting 20 grand, or getting 100 grand in funding just based on inquiries. So you've got to really minimize your inquiries in the business world. It's very, very, very important because inquiries are used for so many things, which is why you have to be so cautious letting anybody do this. So we're getting a merchant account. I just spoke with Megan, our COO, today, and she said, are you good to provide your guarantor? Because they're going to typically need it with merchant accounts, as they almost always do. I said, no problem, but that better be the last thing they do, because my credit's excellent and they're not putting an inquiry on my credit report unless they're going to approve us and give us the account. If that's not the last thing they do, I have no interest in them pulling my consumer credit. You have to protect your consumer credit inquiries like they're gold, because it's so valuable and so important when it comes to you getting money in the business space. It's also meant that creditors want a personal guarantee. So again, it's very common if you provide your social that they're going to do both. They're going to attach a personal guarantee and they're going to pull your personal credit. So D&B uses predictive modeling to calculate your score. Actually, they have two different kinds of scores that they work with. They have what are called performance scores, which are based on past payment history, how you've performed payment-wise in the past. And they have predictive scores, scores that are using a bunch of factors to predict your potential risk of going late in the future as well. So they consider, among other things, the likelihood of your business failure, your business financial stress, meaning, financially, how solid are you? How much money does it look like you have available? What are your revenues, your profits, etc.? These factors are checked against similar companies in your industry, and that's how they rate it. If you look at business credit scores, you'll see that you're oftentimes ranked on a scale based on where you are compared to other people in your industry, which is just one more reason that having a proper SIC code on your actual business credit reports is very important. So D&B provides a rating. It's based on information in your company's or interim fiscal balance sheet and overall evaluation of your firm's credit worthiness. So again, what they're basically doing with their rating is they're basically looking at your financial strength or how financially strong you are per your tax return. So again, what's important here is that, with D&B's rating, with Experian and Equifax, you have a choice whether or not you do or don't supply tax returns to them. And then they rate you differently based on whether they have the financial data or they don't have the financial data. And if they don't have the financial data, they look at number of employees to determine your financial health. Meaning if you're a smaller business, 1 to 5 employees, you are significantly greater risk of default than if you are a bigger business with more employees. Not my opinion, just the way that the rating system works. So again, something you need to know, that the reporting agencies allow you to send your tax returns to them. The tax returns will determine certain scores, also known as a financial stress scores, and it's also where they'll pull things like your SIC code from. So again, with D&B, the scale goes from 5A to HH. These rating classifications show your company size based on worth or equity as computed by D&B. All you need to know, 5A, HH, none of that stuff means anything. What you need to know is this. D&B has 3 different categories they're going to put you in. A, they either have your financial data or they don't. If they have it, that puts you in one category. If they don't, then do they have the number of employees for your business? If they don't, then you fall into the 3rd category where they have neither. You're either in one of those 3 categories. They either have your financial data, your tax returns, they know your employees, or they don't have any of that. And that's going to determine these ratings, these classes that they're putting you into. And again, they're going to assign you a rating only if your company has supplied a current financial statement. If not, they put you in one of those other categories indicating they don't have that data. Now, the delinquency predictor is intended to figure out how likely your company is to be late in paying your debts. This takes historical information into account to predict future outcomes. DB considers objective and statistically derived data rather than subjective and intuitive. So what they're ultimately doing is they're looking at real payment history here to make decisions other than other factors. They use a scoring system to rank and order accounts based on the probability of late payments. However, predictive scoring only represents a statistical probability, not a guarantee. So again, this is why D&B has both. D&B has both again, performance scores and predictive scores so somebody can get the best overall view of the business. In one case, we're predicting what may happen, and on one, we're just rating you based on past performance. When you combine the two, you're looking at all this data through scores that predict your likelihood of default, and then also the scores that reflect how you've paid your bills in the past. Now, a Paydex score is D&B's dollar-weighted numerical rating of how your company's paid its bills over the last year. This is their main credit score, and D&B bases this score based on trade experience. So this is what's called a performance score because it's based on your past performance. Okay, so D&B Paydex score ranges from 1 to 100, as Experian and Equifax's main score do as well. And to get good scores with all of them, you need to have about 80 or 90 score or higher, reflecting that you're paying the bills as agreed. The higher score means better payment performance, means more money for you, and better rates and terms. Now, among other factors, Experian considers your history of trade payments, payment trends, inquiries by creditors. Inquiries don't matter a lot or much of anything into actual specific scores that they offer, but they will look at who's actually pulling your credit report and factor other trending data into account as well. In addition to other factors, Equifax take into consideration credit usage, median open balances, current limits, and your company's 24-month payment history as well. So again, credit scores, very important. If you want to know more about credit scores, go to youtube.com/credit suite. We've got an entire playlist that has to do with credit scoring and the credit bureaus. And there we decode every one of the credit scores that the bureaus offers so you know more. Again, I can't do it today. There's too many scores to even break down all of them, but we've done separate videos just on that topic. So number 2 factor that determines your credit worthiness is repayment history. How well does your business pay its bills? Are it late, early, on time? How late if it is late? Do you pay in part or in full? Has your company performed well over time, especially over the last 12 months? So the credit reporting agencies generally look at the previous 12 months to determine your risk of possibly defaulting. They consider your payment trends. Are you showing continuing payment failures? How late are you? Are you late? Or are you turning it around? Okay. So again, when we look at repayment history, we refer to this on the credit report as days beyond terms, or DBT. So when you pull a credit report and see DBT in capital letters, that means days beyond terms, and you'll see the credit reports have the amount of days that you are behind terms. So it's not just are you late or are you not late. It really comes down to, are you 1 to 30 days late? Are you 31 to 60? Are you 61 to 90? Are you 90 plus? Well, if you've got recent late payments that's showing that you're 90 days plus past due, well, then obviously that means you're a pretty high risk of going 90 days late over the next 12 months. But if you have history 2-3 years ago, where you were 90 days late, and in the last 3 years you've paid perfectly, well, then your risk of going late over the next 12 months is much better than the first scenario I gave you. So repayment history, do you pay late? How late do you pay? How recent are your late payments? All these type of things tie into your credit worthiness. Also will tie into the number 1 factor we talked about, which is credit scores as well. How long have you had credit history for? Are you a startup or new to credit? Then by definition, your credit will be poor or incomplete, okay, if you are a new startup. And as a matter of fact, let me see here. I have probably too many of these to go through. But again, if you do follow us on Periscope or Facebook Live, you'll see we oftentimes, which I don't have time today, show you exactly what you're talking about here on actual commercial credit reports. So go to creditsuite.com. At the top right of our page, like us on Facebook, follow us on Periscope. We go live on Facebook every Thursday at 11, every Wednesday at 4 o'clock with Periscope, almost every week, unless I'm out of town for some reason, like I will be next week. So in those live streams, we look at real commercial credit reports. We see what this stuff looks like on real reports. So make sure you follow us there so you can not just get this in theory, but actually see it on real reports as well. I'd like to go through it, but I just have enough slides to take us all the way through the hour and don't have a bunch of extra time. So as you might expect, the main cure for this is time. So be patient, okay? As short business credit history will often be why a creditor will want to look at your consumer credit report, because you don't have much credit, or they may want a personal guarantee as a result of this. So they're likely to request a social security number to look up your consumer credit scores. Okay, and again, this is what we looked at, right? When we look at commercial credit reports, then the problem, and let me see if I can pull up just a couple examples here. The problem is that when you don't have enough credit, that's when they actually want to see your commercial credit reports. Okay, and I'll give you an example of that here on a real commercial credit report. So here's a real commercial credit report. Yes, I have permission to show you, and no, I don't need permission to show you this because all commercial credit reports are public information. As a matter of fact, during the election, we always pull if the candidates own businesses their credit reports and do all kinds of things on our live streams because it's public information. But you can see here, this is a failing score, 28 to 100. We can see here that the financial risk score, the whole score's the purpose is just to determine somebody's risk of going bankrupt or not. And we can see here that the financial risk score is about as high as you can go. And we also see here the lack of trade. So again, if you don't have enough credit established, then this can often happen where you're given a financial or a failing score indicating this score literally means that you have a risk of filing bankruptcy. So what happens is even when you have no credit, you still show as a high risk of filing bankruptcy or bankrupt. And if you do have some trades, and here's an example of somebody that has a good score, but they only have one credit item on the report, 96 score. We see here there's only one item on the credit report, a packaging account here, probably from Uline. And we can see here that their score is much better. Let me see here. But you can see that the reason their score is not even better is because they even say average age of commercial accounts. So I've shown you examples of the last two that we covered here, how you can be issued a failing score and how you could be considered just because you're a new business with no credit as a very high risk, and how even if you have some credit, the length of time you've had credit does factor in. We can also see what we talked about here, right? Here's the comparison to industry. Industry risk comparison, 95% of businesses indicate a higher likelihood of severe delinquency. So this is lower risk. And they're even telling you that they're making this determination based on looking at other companies in the actual industry as well. So number 3, length of credit history. It doesn't really tie directly into your scores at all. Okay. As a matter of fact, with Experian, 5 to 10% of the score does have to do with the age of the business, the industry, and the size, not necessarily how long you've had credit for. But D&B, Equifax, and Experian's main score do not take into account how long you've had credit history directly, but it will be used to determine your credit worthiness. And you did just see references on real commercial credit reports of how that is a factor when it comes into how the bureaus look at how much you should be lent, recommended for money, the terms, et cetera, et cetera. Derogatory entry. So creditors will look at the number of negatives on your credit report. As you might expect, these negatives are of great interest to anybody that's issuing you credit of any sort, right? They want to see whether or not you are a high risk of actually paying your bills or not. And unlike with consumer credit, there's no time limit on how long they can stay on your commercial credit reports. It's all different. People ask me this question all the time. How long can stuff stay on my credit report? Indefinitely. There's no limit of how long it can be on there because there's no Fair Credit Reporting Act, and all reporting agencies are different, and they're all different on the type of accounts. Some leave them on there for 24 months. Some leave them on there indefinitely. Some leave judgments on for 10 years. Some leave them on there for 3. It's all completely different per bureau and per time of account as well. So typical derogatory entries are tax liens, judgments, bankruptcies, accounts that have gone into collections. Any of these things can be looked at as derogatory items. So just something to keep in mind. Now, D&B, quote, currently D&B, Dun & Bradstreet remains up to 24 months of payment experiences in the trade repository. D&B will use up to 874 payment experiences in total. So they will look at all of your payments over the last 24 months, although they're really trying to determine your risk of going 12 months late. So again, if you have late payments that are years old, then it doesn't make you as much of a credit risk as if those late payments were more recent. Okay, so some things to keep in mind when it comes to how they actually look at these factors. Okay, and here's an example of that, a commercial credit report. You can see here days beyond terms, and you can see here, for example, this one account. These other accounts are fairly new. We can see this account here is 1 to 30 days late 20% of the time and current 80% of the time. So, and you can see here, this is a charge off. So this is what these actual credit reports look like, where you can see the difference between people that pay as agreed, 100% paid as agreed. Okay, you can also see here that somebody actually has a charge off, and then you can see here 20 days, 1 to 30. And again, since this charge off is older, it won't impact the score as much as a late payment like this that is more recent. So something to keep in mind. Now that seems to be meant that after 24 months payment, again, information is really not going to affect your D&B credit score. But again, what happens is the most recent accounts you have will determine the payment history versus actual older accounts that had past payment history that was long ago. So in addition, the D&B website states on an annual basis, D&B cleanses its database to remove the following filings: suits and judgments that have been inactive for 10 or more years, liens that have been inactive for 11 or more years. Hence, certain types of information such as lawsuits, judgments, and liens may be reported for a lot longer than the 24 months, which again, we're not used to. And again, we're not used to this at all as consumers. As consumers, we don't have lawsuits that show on our commercial credit reports, but as business owners, we absolutely do have lawsuits that show up on our commercial credit reports. So Experian, dating data ensures that the information presented in a report is current enough to create an actual picture of financial health. Trade data, 36 months. Bankruptcies that can stay on the report for 9 years and 9 months. Judgments, 6 years and 9 months. Tax liens, 6 years and 9 months. UCC filings, 5 years. Collections, 6 years, 9 months. Government leases, 36 months. Look, you're never going to remember this. Don't worry, I don't either. If you ask me about any of these, I wouldn't remember them off the top of my head because I choose not to. Because every reporting agency is different with all these time frames, and it's too much information to be able for me to store, especially since things like this change. But what you do need to know is this: there's no Fair Credit Reporting Act that restricts how long data can stay on your commercial credit report. So don't screw up. You know, when you pay late, when you have collections, then these things can haunt you for many years. But again, as you've learned, the more recent the negative is, the worse the damage is. So for Equifax, for per commercial credit report information trade lines, they're going to be reported up to 24 months, whether negative or not. Equifax says it does not report collection data from third parties. Experian and D&B does. However, an account could list that it's in collection status with the original credit issuer. In addition, Equifax states that the information can impact the business credit score for up to 5 years. So anything on your credit report can affect your credit score for up to 5 years. So guys, you have to understand that as consumers, we're very used to credit in a Fair Credit Reporting Act world. And the Fair Credit Reporting Act says negatives can only stay on your credit report for 7 years. You know, public records can only stay on there for 10 years. So because there's a law that governs these things, then the law keeps everything uniform. TransUnion, Equifax, and Experian, negatives can only stay on your credit report for 7 years. Then they have to get deleted. It's the same with all reporting because it's the law. There is no Fair Credit Reporting Act in the commercial world. So in our world of commercial credit scoring, it's substantially more confusing than consumer because, like you see, some reporting agencies take into account third-party collection data from collection companies. Others don't. That means the people that have collection companies don't report to Equifax because they know they won't accept it. They only report to Experian and D&B. That means your chances of having harmful D&B and Experian profiles and scores are greater than with Equifax. Well, that's a problem because a lot of credit issuers are looking at Experian to make lending decision. And again, how long can things stay on your credit report? How long are these things calculated into your score? It differs between all the reporting agencies and differs between kind of accounts as well. So again, when we look at this, all in all, derogatory entries can really adversely affect your credit. The question is how much and how long? Well, the easiest way to think of it is like this. If you have derogatory items, it probably makes sense for you to dispute it with any of the 3 reporting agencies. D&B will let you do it through iUpdate. Experian will let you do it through their credit monitoring platform. Equifax, you need the credit monitoring platform, but then you'll manually send in a dispute by mail or email or oftentimes both. So dispute any of those accounts. And the other thing to do is get as much positive on your credit report as you possibly can. The more positive you have to outweigh the negative is going to help offset your risk and increase your credit worthiness. And the more recent positive you have, the more that calculates and weights into your score versus the older negative. So the key is to keep a lot of stuff recent on your credit reports and to make sure you're paying it as agreed. All those things are going to tie in to your credit worthiness. So collateral, for a lot of business lending, collateral is a must, especially with loans like SBA. So does your business have collateral? Consider the lender's perspective. They need to know you can pay back on time, but if you can't, well, then they want something to take from you in return. So SBA, for example, mandates per their underwriting guidelines that any lenders that offer SBA loans actually take collateral, all business collateral that's available to take. And if it's not enough to offset the loan, they want your personal assets as collateral, even including your personal home. So a lot of loans aren't like this, but when you get to the top tier of loans that you want SBA, then those are like this. They want to see this kind of collateral. It ties into your credit worthiness. So this is maybe any property that you own. Okay, it could be property you previously pledged. If it's been a property that's previously pledged, then they're probably not going to accept it. They want to know that they could take that property if you default. It could be equipment. It could be account receivables. It could be real estate or inventory. So I talked to on my podcast last week a really smart guy out of the UK, and what he does is actually, I think he's from Australia now that I think about it. And he's definitely from the UK. Sorry, brain fart there. So what he does is he buys and sells businesses. And I asked him, I said, what do you look for in businesses to get financing? And he said, one of the easiest ways for us to get financing to buy a business is if they have assets. And I said, well, what's the best asset? He said, account receivables. So account receivables is one of the best assets and easiest assets to use to qualify for financing based on collateral. But it was interesting because when I talked to him, I said, well, how do you make the determination whether to buy a business or not? This is one of the things he looked at. He goes, well, assets is one of it, because we want to know, can we get financing? Can we get an SBA loan for the purchase of the business? SBA is going to want collateral. I'm not pledging my personal home, so I need the business to have the collateral to get the SBA loan. What kind of collateral is most common? Account receivable. So again, any of these assets can be used, and this isn't common with places like On Deck that offer alternative financing. But when you're talking about SBA loans, this becomes very, very important. So collateral also could be stocks, bonds, 401k, book of business if you're an insurance agent. So anything you have that has value could qualify as assets. And again, this doesn't matter if you're getting a high risk or high payment revenue loan from On Deck, or if you're going to Cabbage Online or some of these online lenders. But again, it really, really does factor in when we're actually looking at higher level loans like SBA loans, SBA cap lines, people using SBA to buy your business, you using SBA to buy other businesses. These type of things really factor in. Collateral becomes a big factor for credit worthiness. Cash flow, how much money is coming into your business? How much is going out? Can you show you have new business coming in, that you're growing basically from month to month? So current ratio, there's a lot of ratios that they're going to look at here depending on the kind of loan you get. Now, again, if you're going with an on-deck type loan, they're just going to look at bank statements, but they are going to look at some of these ratios. If you're looking at alternative lenders, if you're looking at credit lines, if you're looking at longer-term loans, if you're looking at SBA loans, they're going to look at things like the current ratio, which is basically comparing the ratio between your current assets and your current liabilities. That kind of determines your liquidity. Okay, so current assets will usually be converted to cash within 1 year and include cash and securities, as well as inventory receivables. Okay, so current ratio, basically what you need to know is the ratio between your assets and your liabilities. So banks generally want to see at least a 2-to-1 quick ratio, or twice as many assets as liabilities. So again, not a big deal if you're going through a quick online lender where you're going to pay higher terms. But when you want to get to the coveted SBA type loans, the longer term loans, the 5, 10, 20, 15, 20, 30-year loans at the 5, 6, 7, 8% rates, well, then these are the things they're looking at. They want you to have twice as many assets as what you have liability. A quick ratio. Inventory is part of the value of current assets for a business, but can it be more difficult to turn quickly? Okay, so the quick ratio is similar to the current ratio, but it removes inventory from the equation because, again, inventory might not be able to be turned around and sold quickly by the lender. Debt to equity ratio. simply compares liabilities, the liabilities you have, with the owner's total equity itself. Shows how much of the company is financed by debt versus other amount financed by equity. Okay, so trends over time. So this is a common ratio that's used. Receivable turnover, amount of receivables divided by the total amount of collections for a specific time. So are your receivables actually being collected, or are they turning into collections because they're not paid? Receivables are so valuable to a business. There is more and more financing that's becoming available for business owners purely based on account receivables. Not only is it the number one factor that people are looking at to buy your business, whether that's a viable asset, they're looking at SBA loans, look at this more heavily and favorably than anything else. And there's a lot of financing out there too. There's, Fundbox, for example, and a lot of these online lenders will now give you automated approvals based just on the fact that you have account receivables that are actually getting collected. So your receivable turnover becomes important for SBA loan. It becomes important for quick and easy underwriting decisions for these artificial intelligence systems that a lot of lenders are using. I just can't tell you how valuable receivables are. So again, how long does it take you to receive those receivables, and do you get paid or do you not get paid? Interest coverage ratio. This shows how well the business may cover its future loan payments. So to get this, they're basically just dividing the total operating cash flow, which is your earnings before taxes and interest are paid, by the total amount of interest paid on loans. So again, what they're trying to figure out here is how much money you have available to pay future loans. Okay, and they want to see about 3-to-1 that you've got more than enough money to pay back the money that you're borrowing. Again, for smaller loan amounts, for a lot of alternative lenders, they may not look at this as much, but this is now what's being calculated into artificial intelligence. So when you see these really fast, easy decisions like Cabbage or Fundbox, or there's just so many of these that are out there, then Bluevine is another. They're using these new artificial intelligence systems to determine approval. Well, these are the kind of ratios that these systems are looking at to determine approval. They're tapping into your bank account, they're tapping into your accounting software, and then they're pulling out these kind of ratios, and the ratios automatically, per the AI, determine if you're approved or denied or how much you're getting approved for. So this is why this is important. Look, if you're like me, I don't care about ratios. I'm not a I love financial services, but I'm not big on all these ratios and the mathematical equations behind all this. But by knowing it, I know how to get our account receivables, our accounting software, our books in line to give us the best chance of getting loans. So for example, if I'm going to go out and I'm going to apply for a loan through SBA or a loan like Bluevine or Fundbox that I know is looking at my account receivables, well, then 90 days before I even think about applying, I'm going in and writing off any kind of receivables we're having a tough time paying. I'm going to get all the crap off our books. So then that way, the last 90 days reflects good positive pay through of AR and makes us more lendable. We get more money and we get it at better terms. So understanding these type of ratios becomes important, because if you understand what these lenders and credit issuers are looking for, you can make sure you meet these requirements, giving you the chance of getting approved for the most amount of money at the best terms. So the most effective way to raise business credit scores is to pay on time. Okay, is to also come in and pay in full every time, unless it's a revolving account where it doesn't matter as much. And again, this matters more than anything else, is basically paying your bills on time. That's what a lot of these ratios really come down to, is your ability to pay. So developing a good repayment history is crucial. And you can, again, start with smaller vendors. Okay, these are trades who offer like net 30 terms. Uline, Quill, Monopolize Your Marketplace, Granger. These guys offer you terms that you do have to pay in full, because they're like net 30, which means the whole amount's to be paid in 30 days. And again, you're less likely to be turned down. Even as a startup, you can get these, which again makes you more credit worthy. And they often don't pull your credit reports at all. Granger, Uline, Quill, they don't even ask for your social security number. So again, you know they're not pulling your personal credit report. And in doing so, they issue you credit that helps you establish a long credit history. It helps you get payments on there that are paid as agreed. It helps you offset a lot of these things that we've talked about so far, so you are more credit worthy. So continuing to develop a good repayment history means after getting your first initial trades, 5 to 8 of these type of vendor accounts, then you want to start getting revolving store credit, the Amazon, the Apple, the Best Buy, credit at most major retailers. As before, you want to pay on time, but not necessarily in full. You just have to make sure that your full payment is paid. If your minimum payment's $100, then pay $100. Don't pay it short, or they'll count you as late. It becomes very important. With 10 or more accounts, then you can move on to fleet credit. That's, your fuel card, your Sunoco, your Exxon, your Fuelman fleet. This is for auto vehicle repairs and maintenance and for fuel. And this is credit to do all those type of things. And again, pay your bills on time. After you get to the top tier of business credit, 10 or 14 trades, then your limits get higher. This is the way credit works. The more credit you get, the more credit you'll get approved for, the higher the limits. The key is just to keep getting credit. These are cards accepted in more places. Visa cards, MasterCards, auto vehicle financing, all becomes available. You have about 10 to 14 trades on your commercial credit reports. And about the only thing you can do about the length of time that you've had credit is be patient and add stuff early and let it stay on there as long as possible. So I'm always asked this question. I'm on a lot of radio interviews and podcast interviews, and the one question that I'm asked a lot is, what's one thing that every business owner should do? What's the one piece of advice that I give every business owner? And it's almost always the same. My answer is get credit before you need it. Business credit building takes time. And since business credit's partially based on how long you've had credit history for, you never want to wait to start building business credit until you need money. Start building it the minute you set up your business, because it helps you get money then when you need it, because you have an established business credit report, you have established payments, you have a length of credit history. So this is why you don't want to delay when it comes to building real business credit. In the meantime, as you build credit via trade lines and more, the time will pass that will help improve your credit. Now, remember, the beautiful thing about business credit is that the scores are primarily, with Equifax and DMB, they're completely based on how you pay, payment history. Experian does take into account age of business, but it only calculates 5 to 10% of the total score, while 85% of your Experian scores how you pay. So even though there's not much you could do about length of time that you've had credit, you can control the one dominating factor that makes up your scores, which is how you pay your bills. Get as many accounts on there as pay your bills. That goes so far to determine your credit worthiness. So make sure that you add as many trade lines, accounts, what are called payment experiences, as you possibly can. It becomes very, very, very important. And Patrick says, did you say the number of credit inquiries affect, or does it? It doesn't affect your credit score, but it can affect your actual credit worthiness, meaning that that's not a factor that factors into any of your credit scores. With DMB, Equifax, and Experian, inquiries do not affect your score, but it is sometimes looked at to determine your credit worthiness. So what happens is if somebody pulls your credit report and sees 10 inquiries, but then they also don't see that you really have any credit reporting, or any of those accounts ended up in being approved accounts on your credit report, well, then what happens then is that makes you a higher risk. So again, doesn't affect, Patrick, your score, but it will affect your credit worthiness by those that are looking at how many inquiries you've had, how many of those turn into actual deals. So you can prevent some derogatory entries by being responsible with credit. Businesses which pay bills on time don't go into collection, and they're a lot less likely to be sued. Again, remember that collection companies do report to a couple credit bureaus. Remember that lawsuits show on your credit report. So anything you could do to prevent an account going into collections, you need to, because not only can that be reported by a third-party collection company, the original creditor then reports it as an account that's late. Then you have a lawsuit on your credit report. It could have multiple implications that are adverse if you let it get this far. And the other nice thing about this is a lot of collection companies just want to get paid, so they'll tell you they're going to report the item before they ever do. And if you get those letters, you need to pay attention. You need to call the company. You need to see what you can work out so they don't report it. Because again, lawsuits, judgments, third-party collections, the original company, all these things can show up on your credit report and cause all kinds of damage from one event. And where, again, we are not used to this in the consumer world. The Fair Credit Reporting Act won't let that happen. It says that only one account can be reported on your credit report. But in the business world, you could have it show as a lawsuit. It could show as a lien. It could show as a third-party collection from the actual third-party collection company. It could show as the original creditor as collection. You could have 3, 4 different kinds of adverse reportings from the same account, which is what we're not used to in the consumer world. So again, try contacting the reporting agencies. I'd say don't even wait a year. If you have a derogatory item on there, dispute it with the reporting agencies. If you don't think it's accurate, the worst that can happen is they verify and keep it on there. And in a lot of cases, they just remove the negative item to begin with. So again, you're never going to ask if these items can be deleted unless you know, unless you ask. So be creative if you need to come up with collateral. Okay, an investor may want you to come out to help you basically come up with something to offset the risk. So your company's account receivables can be tapped. So can your equipment, your inventory, okay? So again, think about the assets you have. When you go to sell your business, it becomes important. When you go to get high-level loans, it becomes important. When you go to even get now simple online loans that are using artificial intelligence, it becomes important. The assets you have, especially receivables, really tie into your ability to get financing, i.e. they tie in to your credit worthiness. So think about that as you're accumulating assets in the business. Now, you can't always predict or improve your cash flow, but you can fire clients which don't pay you on time. Remember, account receivable financing looks at the amount of receivables that are getting paid through and who aren't. So if you have people that aren't paying, don't keep them on your books as outstanding receivables. Get rid of them, write them off, or they can actually adversely affect your ability to get money. Okay, so you can also give your uncollected invoices over to a factoring company or a collection company as well. Okay, and factoring companies for a piece of your invoice will pay you the majority of your invoice. So if you have account receivables, it's another benefit. If you have account receivables, as I've already mentioned, there's all kinds of this type of financing, whether it be loans or credit lines, that uses those account receivables as a strength for you to get money. So kind of a recap here. Business credit accounts for a business's ability to pay back its debts, not the owner. It's not subject to the Fair Credit Reporting Act. So we've seen multiple things where that causes issues here. There's no systematic reporting for how long accounts can stay on your credit report. There's no limit of how many times in different ways a negative account could be reported, which could adversely affect you. There's no system for actually disputing items. So all these things are different because there's no FCRA. Creditors consider your business credit scores and payment history, probably more important than a lot of other things. How you've paid your past bills is going to determine your ability to pay your future bills, which is, again, especially if you have consumer credit issues, why you need to build your business credit, why you need to make sure you have a positive payment history for the actual business. Creditors do consider the length of your credit history, although this does not factor into your credit scores, nor do inquiries. Inquiries and how long you've had credit for don't affect your commercial credit score, but they do consumer. So in the consumer world, new credit or inquiries accounts for 10% of your score. The length of time you've had credit's 15% of your score. 25% of your score is based on inquiries and how long you've had credit for. None of it calculates into your commercial credit scores, but it is looked at by lenders, credit issuers, and suppliers outside of your credit scores. And of course, derogatory items are looked at as well. A lot of lenders are looking at the collateral, some collateral like account receivables, inventory, 401ks, purchase order, stocks, bonds. That can individually by itself be used to get you money. And in other cases, it can be used to offset the lender's risk for coveted SBA loans, for example. Okay. Creditors check balance sheets to determine business credit worthiness as well. Not all of them, but a lot of lenders, when you start to get to SBA loans, alternative lender, venture capital, private investor money, they're going to look at some of these things. And remember, Other ratios we've talked about here, the current ratio, the quick ratio, the debt to equity, the receivable turnover, these things are now being plugged into computers used by artificial intelligence that give you immediate decisions. So when you start to see more of these lenders pop up like Fundbox, like Bluevine, like Cabbage, that tell you clearly they are either plugging into your bank account or they are plugging into your accounting software, you need to know that this new AI that's out there in the lender world is automatically calculating these kind of ratios. And we've talked about the 2-to-1, the 3-to-1 type ratios they want to see for you to basically be issued an immediate green light automated approval or an immediate red light denial with these automated systems. Guys, this is the future of lending. This is why I'm trying to kind of get you ahead of the curve, because by understanding that what happens is these ratios are being calculated automatically and used by computers to render decisions, you now know what to look for before you even apply. So work to improve your credit worthiness. Paying your bills on time is the most important thing you could do, especially accounts that report to the business reporting agencies. Try to stay out of derogatory hot water. Remember, item gets into collection, there's all kinds of repercussions there. Collateral can be used by itself to get you financing or is oftentimes needed for higher level SBA type loans and cap lines that you may want to get as well. And get your company into a good cash flow rhythm. What they care about in a lot of cases with lenders is that you have less money going out than coming in. You have more money going into your bank account than going out. And that's what these algorithms are really looking for. Do you have account receivables? Great. Do your customers pay your bills or not? Do you have revenue? Great. Is your revenue growing month to month, year after year, or is it not? If you have a successful business, they expect you to be growing. They expect the cash flow going into your bank account to increase. They expect you to have more money, cash in hand, more assets. And in doing so, those ratios get better, which make you more lendable. So a lot of things we talked about today when it comes to credit worthiness. Thank you all very, very much. I hope you have a great day. And remember, if you have any questions about getting financing or credit for your business, then give us a ring, 877-600-2487, or send us an email, info@creditsuite.com. Thanks, everybody. Have a great day.
You've been listening to the Business Credit and Financing Show with your host, Ty Crandall. Watch for our next episode to get even more insight on financing and growing your business. And don't forget to check us out online at creditsuite.com for even more business growth strategies.